Gold just crashed below $4,000 while Bitcoin bleeds near $59,000. This isn't random panic. It's the same bet on debasement collapsing because interest rates are rising again. Tuesday, June 30th, 2026. Like and subscribe for daily market updates. Today's agenda: Hook Market Snapshot, Macro and Central Banks, Geopolitical Status, Commodities and Crypto, Earnings, IPO and Deals, Closing Summary. But why is money leaving safety? Let's look at Washington. It's Tuesday, June 30th, 2026, the last trading day of the quarter, and the two assets sold to you as the ultimate stores of value are both bleeding out at the same time. Gold, the 4,000-year-old a safe place to store wealth, is back below $4,000 an ounce, and it's heading for its worst quarter on record. Bitcoin, marketed as digital gold, is sitting near $59,000, down roughly 50% from its peak. Here's the thing nobody tells you. This is not two separate stories. It's one trade unwinding. And today we're going to follow the money to find out exactly why. And while Washington talks, global politics are trying to distract us from this reality. Let's set the board. US stocks ripped higher to start the week. The Dow closed above 52,000 for the first time ever, a record, finishing around 52,180, helped by Alphabet officially joining the index and a rebound in big tech. The S&P 500 added more than 1% to around 7440, and the Nasdaq jumped about 2%, clawing back a brutal previous week. There was also a political tailwind. The Supreme Court protected the Fed's independence, ruling that Governor Lisa Cook keeps her job. Markets like the certainty. So far, so risk-seeking. But now flip the coin. Gold is hovering just under $4,000 after dipping below that line again. Bitcoin is near $59,000. Silver is around $58 to $59, below $60 for the first time since December. Here's the tell. Money is rushing into stocks, specifically AI and big tech, and out of the things that protect you when the system wobbles. That rotation, from the safest assets to the riskiest, is the entire story of this market right now. Up next, geopolitical status. And it all traces back to one building in Washington. The Federal Reserve is holding its benchmark rate at 3.5% to 3.75%, but the man now running it changes everything. Kevin Warsh took over as Fed chair last month, and at his first meeting on June 17th, he flipped the script. For most of this year, the market expected rate cuts. Warsh erased them. The Fed's own projections, the dot plot, the chart of where each official thinks rates are headed, now point to a rate hike before year-end, with 17 of 18 officials saying the bigger danger is inflation, not a slowdown. Traders now put the odds of a hike by December near 70%, up from roughly a quarter a month ago. Why does this matter for gold and Bitcoin? Because both pay you nothing to hold them. When the Fed signals higher for longer, cash and bonds suddenly yield more, the dollar climbs to a 13-month high, and the 10-year Treasury yield sits up near 4.5%. Every one of those forces makes a shiny rock or a digital coin look worse by comparison. The inflation that the Iran war ignited is still hot. The Fed's preferred gauge, the PCE index, has been running well above the 2% target, and the Fed's answer is to stay tight. That answer is squeezing every non-yielding asset on the board. Warsh has also made himself clear in tone. He calls persistently high prices a burden, says 2% inflation is the goal and he won't revisit it until it's delivered. And he stripped the Fed's statements down to the bone, dropping the forward company outlook language markets used to lean on. For an investor, that means more unpredictable price swings around every inflation and jobs print from here, because the Fed has stopped telling you what it will do next. But not all stocks are red today, because the corporate tape is still alive with big deals and launches. Now the geopolitics, because it's the plot twist most people get backwards. Over the weekend, the US and Iran escalated again. Iran struck at shipping and US military sites in Kuwait and Bahrain near the Strait of Hormuz, and the US hit back. But both sides have now agreed to suspend the attacks, and peace talks are set to resume today in Doha, Qatar. Oil drifted back to around $70 for West Texas crude. Here's the counterintuitive part. You'd expect gold to love this kind of flare-up and hate the prospect of peace. Instead, gold barely rallied on the fighting and keeps sliding as the path to a deal opens up. Think about what that means. The war premium that propped up gold is draining away, and with it goes one of the last reasons to own it. When even live missile exchanges in the Middle East can't lift the world's oldest a safe place to store wealth, you learn something important. Right now, interest rates are running this market, not headlines. The rate channel is drowning out everything else. So here is where we stand with the market mood, showing a clear split screen between winners and losers today. The core story lies in metals, and coins finally revealing their true relationship against each other. Gold sits just under $4,000, down roughly 29% from January's record above $5,500. It faces a fourth straight monthly loss and its steepest quarterly drop on record, a decline of about 14%. Silver has also broken below $60. The official driver is straightforward, in favor of higher rates Fed, a soaring dollar near a 13-month high, and rising real yields punish assets that do not pay coupons. Bitcoin trades around $59,000, off approximately 50% from its October peak near $126,000. Crypto fear remains in extreme territory. For 2 years, gold, silver, and Bitcoin represented the same bet. Wall Street calls it the debasement trade. The thesis was that runaway government spending would destroy paper money value, so investors parked wealth in scarce assets governments cannot print, gold for traditionalists, Bitcoin for new ones. They rose together on this path. Now they fall together as in favor of higher rates Fed, and strong dollar unwind both bets simultaneously. Institutional exits are brutal. Bitcoin spot ETFs lost over $4 billion in June alone, their worst month since early 2024, with roughly $6.5 billion gone across May and June combined. The buyer meant to be a permanent floor is heading for the door. Capital drains from gold and crypto into AI stocks, creating one clear rotation, out of scarcity into the AI story. Crypto investor mood reflects exhaustion rather than euphoria or panic selling. Borrowed money has flushed out, while buyers wait for reason to return. A key nuance remains. Even in this brutal slide, Bitcoin has outperformed gold and silver since February. It fell harder early but clawed back ground against metals on the way down. This dual nature defines it as both a wild risk asset trading like tech stock and a hard money hedge trading like gold. Currently, both readings point downward, making the fall feel relentless. The critical level to watch is $60,000. Holding above it opens the door for relief. Losing it on a weekly close likely triggers forced selling waves. Until then, remember the lesson of this quarter, which ties everything together neatly into one simple sentence right here now. It's not all red, the corporate tape is alive. Rocket Lab announced an $8 billion deal to acquire satellite operator Iridium, and space stocks lit up. Iridium jumped about 25%. Comcast rallied after saying it will split into 2 public companies. And looking just ahead, a firm called Securitize is set to list on the New York Stock Exchange this week as the first pure-play tokenization company, turning real-world assets like bonds and real estate into tradable digital tokens. The signal under all of it is the same one driving gold and Bitcoin lower. Investors want growth and a story, and they're paying up for it, while the defensive corners of the market go begging. Finally, let's turn to closing summary. So here's where we stand. The mood is a split screen, record highs in stocks, multi-month lows in the things that are supposed to protect you when stocks fall. The single biggest risk to this trend is the data this week. With markets closed Friday for the 4th of July, the June jobs report lands a day early, on Thursday, and Wall Street expects around 170,000 new jobs. A strong number hands the Fed even more reason to hike, and that's more pain for gold and Bitcoin, the biggest opportunity. If that jobs report comes in soft, the whole higher for longer story cracks. The dollar rolls over and the most beaten down assets, the metals and the coins, are exactly the ones that could snap back hardest. Watch 2 things. Fed Chair Warsh speaks at the European Central Bank's forum tomorrow, and the jobs print hits Thursday morning. Until then, remember the lesson of this quarter. Digital gold and real gold turned out to be the same trade, and the Fed holds the off switch for both. If a clear, honest read on the market is worth 9 minutes of your day, subscribe. See you tomorrow. Gold has surged by 4%, while Bitcoin climbed nearly 6%, yet both assets are currently experiencing a significant trade unwinding. This correction follows an aggressive rally that pushed gold prices above $2,300 and sent Bitcoin toward the $59,000 mark in recent sessions. Market participants are now taking profits after these rapid gains, causing volatility to return as early buyers exit their positions. Despite this pullback from fresh highs, both commodities remain supported by broader macroeconomic factors, including persistent inflation concerns and ongoing geopolitical tensions that continue to drive investor interest toward precious metals and digital stores of value alike. Thanks for watching Market Pulse Daily.